This video is sponsored by Refinitiv, the company that powers the financial markets.
The 2019 was supposed to be this huge year for technology sector initial public offerings, and it was to some extent. Uber, the ride-hailing service, Lyft, smaller rival, they did go public earlier in the year. WeWork was supposed to go public, but that was a terrible flop and even never happened. Uber and Lyft, the valuations came right down during the course of the rest of the year, and they're way lower than the hype we got before these companies went public. Now, Gina Chon is joining us from San Francisco to talk about this. Of course, we expect more tech IPOs in 2020. Many of them are these unicorns, these companies worth more than $1 billion that we hear about in private markets, and then they come to the public markets and people think they're going to be worth that much. Is that right? Is that totally wrong? How should investors think about that?
Well, I think 2019, as you said, Richard, shows why investors need to have a healthy dose of skepticism, partly because there's a lot of things that the private market allows that can kind of skew some of these valuations or set them in a different light than how public market investors would value them. Right,
so let's tick through a few of those. I mean, one is kind of the advantage of timing. I mean, once you start an IPO process rolling, you kind of either have to abandon it or see it through, whereas it seems like in the private markets, there's a lot of picking and choosing of when to do a funding round, as they call it.
Yeah, exactly. If you think you're going to have what's called a down round, which is lower than your previous valuations, then you can simply just avoid it if you don't actually need the capital. One example is Dropbox. In 2014, they raised about $350 million at a $10 billion valuation, and then actually waited 4 years before they raised money again. And that was in their IPO when they were valued around $8 billion. So you can see some of the differences that timing makes.
But I think what you just, that example there is an example of something else in private markets, which is, sure, the sort of extrapolated valuation of the company might be $10 billion, but the amount raised is tiny. So it's a little hard to say there's a whole bunch of investors owning that company and they all think it's worth $10 billion. In fact, there's not even remotely that much sort of stock out there.
Yes, when it comes to some of these so-called liquidation preferences, as you say, it skews the value for certain investors. And some academics recently did a study about this phenomenon and found that for some of these unicorns, their pre-IPO valuations were actually almost 50% higher than their fair value. So there's definitely big discrepancies there.
All right, Gina, thank you very much for that. Let's hope investors in public markets at least are a little more cautious and skeptical in 2020. And we'll have more breaking views for you tomorrow.